Hi everyone, welcome back to my channel. This is part 6 of my volume price analysis series. We're going to be getting into more advanced concepts in this video. I plan to get in what really drives the market and how large institutions cycle through phases that they repeat over and over. I've seen these concepts called a lot of different things, such as order blocks, fair value gaps, imbalances, market structure breaks, and many other names. However, the reality is these are straightforward patterns that happen over and over as a way for big money to create liquidity in the markets. If you learn to identify the phase a particular instrument is in, you can ride in the wake of smart money and reap the financial rewards of doing so. So before I get started, if you'd like to get a 10% discount for TradingView, don't forget to use my referral link in the description. You'll also find referral links for TradingView and Top Step funded trader programs that will give us both discounts. Lastly, if you enjoy this content, don't forget to like and subscribe to help me grow this channel. This is something I love doing, and we'll have plenty more coming in the near future. I should also mention that the concepts in this video come from the book Volume Price Analysis by Anna C. And I'll be sure to include a link to the book in the description. The book was truly eye-opening for me and has helped make me the trader I am today. Now, if you haven't already watched Volume Price Analysis Part 1 through 5, make sure you watch those as well to fill in some blanks. Those videos are much more beginner to intermediate than this video, so it's important to understand the concepts in those videos before moving on. That being said, let's get right into the advanced volume price analysis concepts. So what I want to talk about is what this is all based around, and this is based off of theories that Richard Wyckoff and others have put out there on what drives markets, why they behave the way they do, the psychology behind them. And basically, Wyckoff is broken down into multiple phases, which we'll discuss shortly, which would be accumulation, distribution, testing, and then the various climaxes of selling and buying. And let's for a second talk about why things are this way. And if you think about the problem that big hedge funds and market makers and big banks have, is that they have a product that they're selling, which are shares. There's a finite amount of them. They can't just go and manufacture more of them. There's literally a limited amount. Now, that being said, of course, there's times where splits happen and more shares get created and things like that. However, 90% of the time, they're operating on a finite resource. And essentially what they need to do is they need to accumulate this resource, and then they need to make sure they accumulate it for a low amount, and then they need to convince people to buy this resource from their stockpiles and their warehouses, let's say, as an analogy. They need to convince people to buy it for higher and higher prices until they deplete that warehouse in some sort of distribution phase, and then they need to flip back to an accumulation phase and do it all over again, buy it at a lower price. So their techniques for doing that vary, and oftentimes they'll use news and earnings and things like that. And essentially what's happening is the whole buy low sell high concept that so many retail traders get wrong, but they're the ones driving that, and they're the ones that are best at it. So let's talk about how they do that and what that looks like. So the first phase I want to talk about is the accumulation phase. And when this phase begins, you can see here what it looks like. This is where they are accumulating stocks, so or shares or whatever it might be. I mean, it really can be any instrument that can be traded, but for the sake of this video, we'll keep the focus on stocks. These concepts also apply to Forex and, of course, options trading. I mean, stocks and options go hand in hand. It applies to future trading. You see this stuff everywhere. However, the accumulation phase is where they are stockpiling shares, right? So they need to replenish their warehouse. Let's say they don't own any of the shares and they want to stockpile it for a lower price. So coming off some sort of news, they start bad news, bad earnings, whatever it might be. It's a bear market, so they can pretty much pick any stock they want right now. For the sake of this video, let's talk about a firm which has been hammered lately. So their campaign starts, and we know they start buying because we see it average volume most of the time as the thing's been plummeting, but all of a sudden we start seeing ultra high volume, high to ultra high volume relative to the previous volume we've been seeing. And that means that someone with billions of dollars, a hedge fund, a big bank, is accumulating this to fill up their warehouse right? The analogy of the warehouse. We'll keep running with that. And so every time they buy, they don't want to just buy billions all at once because that will just send the thing skyrocketing again. So they have to buy strategically. And every single time they buy, because they're dealing with so much money, we see these huge volume spikes. And this creates some sort of pattern that most traders are familiar with, whether it be a wedge or a rectangle or a triangle. It's not always just a triangle like we see here, but it does create some sort of pattern where they're stopping things. So the thing's been selling off, someone else or them in some cases have been distributing it, and at this point now they're buying it. And this is what it looks like when they're accumulating it. We see a lot of volume coming in, and they're preparing to move this thing out. Now, how do we know when they're done accumulating it? Well, what we actually see is a testing phase. So previously there were areas of heavy selling volumes, and so they accumulated a whole bunch of shares, and at this point they want to start driving it up. So they want to see if the market's ready. So what they do is they let their buying power push the stock up some, which you can see here, and they see if it gets rejected, if it gets sold into. And if it doesn't get sold into, meaning it actually gets bought up on low volume, that means that they're done. Their work is done. They've accumulated all their shares, and the testing has completed. People are eager to buy because the fear is over, and so they can let this thing push out there and start all those shares that they accumulated for the lowest possible price that they could get. They're ready to start allowing people in the market to buy those shares back from them at a higher price. And the test works if the thing pushes up out of this accumulation phase on low volume. Now, it fails if they immediately, so they go to try to push it up, and let's say it gets rejected right here. This means the test failed. This means that there's still a lot of selling pressure on the market, whether it be a different big institution that's going against them, or whether it be retail traders that still have a lot of fear, and they see the thing moving up and they immediately sell into it. Well, that means the test failed, and for them that basically means they need to back off, right? Which you can tell the test failed because it goes to push higher, immediately gets pushed back on a bearish candle and higher volume when it's leaving that accumulation phase. And so what they do is they say, oh, buyers aren't out there yet, I'm going to back off, let this thing keep selling down. So they back away from what they've been doing, where they push the market up, or I'm sorry, where they use their stopping volume to accumulate shares. They actually back out of this entirely, and when you see this as a failed breakout, this will actually come back down, and they'll actually let it fall through this consolidation zone, which if you've done any amount of trading, you are intimately familiar with this, where it looks like something is about to break out and then fails. Well, that's why. It's because their testing phase has failed, market has rejected it, and they're fine with that. They just let it fall further, and they begin this whole accumulation process at a lower price. So now, if the next phase I want to talk about would actually be the opposite of that, the distribution phase. So at this point, they've had, they've accumulated all their stocks, and retailers have been pushing it up, and then in the distribution. So when they get here, we basically see that at the top, where we see, okay, they're ready to start selling into that, and what that means is, so their warehouse has been full, right? They've put some news out there to start driving this thing up. And let me go back to the test that passed. The test has succeeded. The stock's moving up. They do inject small amounts of their shares in there to keep pushing it up. The campaign has been going. Now they're ready to unload their shares at the highest possible price. And what do we see? We just see this at a different point where they start selling. They're offloading their shares. Previously they were buying, but now we're seeing stopping volume at the top, same sort of deal, in some sort of consolidation phase, which can be a wedge, a triangle, a rectangle. The pattern does not matter, but what does matter is that we see things getting stopped up. So the thing's been running at this point. Retailers like, holy crap, I have to get in. This stock is going to the moon. This is never going to end. AMC to $1,000. And I'm sorry, I don't mean to insult any AMC apes out there. I'm just using it as an example because it just came to mind. So, this stock is going to $1,000. So everyone and their grandmother's buying in, and that's when the big money, the hedge funds, the big banks, that's when they start offloading their warehouse. So they have this huge stockpiled warehouse full of shares, and they start selling into that, and things get stopped up. But the thing is, with things being stopped up like this, it's not like a normal pivot where you see it kind of go down on low volume and then go back up on increasing volume. Instead, in this case, we see ultra high volume, and we usually see wicks showing us that like this thing is getting sold into. So we see topside wicks with ultra high volume, and that means they're offloading their shares because they feel that they can now sell those shares for the highest possible price that people are willing to buy, and they can offload all that inventory into all these eager retailers just thinking that the stock is never going to stop running up. And so that's the distribution phase where they're distributing the shares that they own. And they don't stop until pretty much that warehouse is empty. Now, it's worth noting that they always have some shares that they need to hold on to. And again, that's because of the testing phase. So essentially at this point, they've emptied their warehouse. Now, before they buy back, their goal is to drive that price down, right? Because they're not going to buy back at the high prices that retailers brought at. So what they do is they always correlate it again with some sort of news, whether it be earnings or inside ownership or bad news on the individual security or macroeconomic news, high inflation. They count on the president saying something that scares people, whatever it might be. They want that thing to drop. And so previously, when there was all this buying going on, and then they stopped it up and distributed all their shares out into the market, now they want the thing to go down. And again, to gauge that interest, to make sure that people are scared enough to sell this thing, they do a low volume test. They do what they can to push it down further using their resources that they have available to them. And if sellers sell into that thing and creates that topside wick, then okay, they're good to proceed with their plan. Now, if people are still eager to buy this thing because the news wasn't bad enough, or people are still really anxious to buy it, then they'll see buyers eat it up on a high volume. So it'll be a high volume bullish candle trying to come out of that previous consolidation phase, and they say, okay, there's still buyers in the market, let's let them push it up. And you can actually see this on the charts. You'll actually see it get pushed up on diminishing volume, and then eventually when that steam runs out, they go back to their distribution phase and sell into that on high volume in an effort to get ready to push that thing down again. And they'll test, and they'll do it until they get a successful test. And now, so when these trends are ending, so basically when we've reached a selling climax, so at the end of this bull trend, that's when we see this distribution phase beginning. And this is what it looks like. This is what I'm talking about. The selling climax, you have all this ultra high volume and a consolidation area, and you have all these topside wicks, which are all bearish candles. And the candle doesn't necessarily have to be red in order to be a bearish candle. It can be a green candle, but if that wick is like larger than 55-60% and you see it on ultra high volume, that means they are trying to push this thing down. Big money is trying to push this thing down, and you do not want to be on the wrong side of that, because even if buyers can push it up for a little bit longer, which does happen all the time, they're fine with that. That just means whatever they have remaining in their warehouse per se, they'll just sell it off at a higher price. So when you start seeing this sort of activity, know that you've hit the selling climax. And the same thing is for the other side of it. When something's been dropping, and they want to start accumulating, and you start seeing these bullish candles and bullish wicks pushing it up on ultra high volume, they are now buying. And again, you want to be on that side with them. And this is oftentimes where you'll see me talk about sitting limit orders down with all these wicks, because I want to get it at the bottom of this thing. I don't want I mean, you can chase the breakout. I'm not a fan of chasing the breakout. If I am late to it, I'll wait for a break and retest out of consolidation rather than just trying to buy as soon as it goes out, because you have to keep in mind they always test, right? They're smart with their money, and that test may indeed fail. And if they see that test fail, then all of a sudden that's where you have a false breakout, where you think the thing's about to go up and break out, but then the test fails, people are still selling into that thing, and it will actually come down further. It will come down lower than where they initially started their accumulation, where they initially started building that bottom. So that's why false breakouts happen, and that's why it's always nice to be in when you start seeing these wicks with some sort of limit order down here, because when things do start moving up and their testing phase on low volume fails, then you will see that and you can get out for small profit or break even, worst case scenario, but you don't take a loss. But as long as you notice what phase is happening, you can get in with them and you'll rarely lose. I mean, not only will you catch moves at the beginning, but you'll also you'll maximize your profits by catching at the beginning, but you'll also have a much higher win rate. So it's really the best of both worlds once you understand what's happening. And one thing I want to take a second to note is that this is happening all around the market on all time frames. So it doesn't matter if you're a long-term trader, a swing trader, a short-term intraday trader like me, whatever it might be, these accumulation and distribution phases are happening on all time frames. They have all types of algorithms running, all types of groups that are doing all sorts of trading, and they're all following the same sort of agenda here. And what's nice about this is, let's say you see some sort of accumulation phase happening on the 4 hour, well, you can actually capitalize on that in the 5 minute. And as long as you line up that bottom properly and you use all the stuff we talked about in the previous video, where you're looking for these high volume wicks on the 4 hour and you're doing your best to catch the bottom of it, even on a lower time frame, you can really catch some huge moves, like hundreds and hundreds of percent moves. And so, but regardless, if you prefer to trade on the 1 day, the 2 hour, the 30 minute, the 5 minute, that's up to you. But you'll see these patterns happening all over, and it's like this Russian doll example, because it's patterns within patterns within patterns of accumulation and distribution and Wyckoff theory. And so what's amazing about this too is if you're ever lost, so like let's say you're trading on the 15 minute, because that's what you prefer, and you aren't sure where we're at with things, well, I highly recommend going up a time frame or two and down a time frame or two. Try to think of it as like rear view mirrors, where you're checking to your left and to your right behind you to get a better picture of where you are at on the chart, and that really will help shed some light. Okay, are we at the selling climax on a higher time frame, or are we at the buying climax in a lower time frame? And is that why things are looking odd to me on the time frame I'm on? So always make sure you're looking at multiple time frames, at least one higher and one lower. Not only does that help with setting levels and things like that, where you can identify where price will typically react, where they've done accumulations and distributions in the past. That's essentially what creates these big levels that we always play. And of course, by setting levels on higher time frames, when you come up to them on lower time frames, you have a significant advantage if you labeled them properly, because you know exactly what to expect. So yeah, I just wanted to point that out. Doesn't matter which time frame it's on, these are always happening. And these principles I just discussed go by many names, right? So you'll hear people talk about order blocks, fair value gaps, market structure breaks, liquidity pools, ABC patterns, Elliott wave theory. One thing I've noticed about all these is they're just summarizing the same stuff that I just talked about. And of course, these all go very deep, and they'll use Fibonacci's to measure it and things like that. But it astonishes me because all of these are price action based theories, and none of them incorporate volume. And if you just incorporate volume and you think about the different phases that we just discussed, you'll actually see exactly what's happening. And it's really just them creating liquidity for a finite resource that they're trying to buy low and sell high. And that's what it all really comes down to. So whether you know, these all work. I mean, that you can make so much money off ABC patterns and knowing where liquidity is at, and market structure breaks and fair value gaps. But they're all just price names on. They're basically what they're calling the price action, without looking at the volume. And it just blows my mind how volume. I mean, volume just confirms price action. Basically, it tells the story. It helps you formulate the thesis. It tells you, okay, if we're dropping and we see a bunch of stopping volume come in, but then it keeps dropping, that they just had a failed accumulation phase, and they're going to try to do the same thing when it gets a little lower, but you know they're trying. And the same thing on the other end, you know, it keeps rising, and you see stopping volume come in, but then it keeps rising. Okay, they just had a failed distribution phase. Or, you know, you see it reverse on you. You see what people call a market structure break, and you're not sure why, and that's because they are ready to begin their next phase. And so I took this screenshot earlier today because as I was trading, we were just coming out of an accumulation phase, and I noticed that they wanted to test to make sure that there were indeed buyers present, and when they identified that buyers were present, there was a big move. And then so of course everyone jumps in, and it's pushing up. And this was actually on the, I want to say this was a 3-minute time frame. I wish I would have included the times below, but regardless, it doesn't matter. It works on any time frame. And then all of a sudden we got stopping volume, we got the wick showing, and now this is what people call a fair value gap, but the reality is now they're just ready to begin the next phase, right? So they just had a bunch of liquidity that they need to create. They push the price higher, and now this was a very rapid move. So then what they do is they create some selling pressure from the top, and then they let the thing come down. And because there was so much rapid buying, there was this buying imbalance occurring here. It does gradually move down, and almost like what you could say, this zone down here is sort of a magnet for price to come down to because of this imbalance, because of this fair value gap right here. But the reality is they're just ending one phase successfully and then starting another. And that's the thing to keep in mind here, is it's just they're always going through these phases, and sometimes one phase can look slightly different than the other, but you just need to realize what's happening when you see all these top side wicks, right? So this is a perfect example of a failed test where they try to push it lower and then it gets bought right back up. That means all these buyers that were eager to get in right here were hoping this was a pivot, and they weren't done. But then sure enough, big money had other plans and pushes it back down, and eventually those buyers do break. The weaker buyers do break, and then it starts moving back down slowly but surely. And so I just want to make a point too that options flow is still very valuable with this whole process. Keep in mind, one options contract equals 100 shares. So the way I look at it is flow data, whether you're looking at live flow or using algos to help you parse that flow data, whatever it might be. It's not the end all be all, but what it is just deeper insight into the volume. So there is a lot that can be learned from that, right? It can help you determine, okay, are we in an accumulation phase, and is some speculative buyers getting ready to push this thing higher? Flow can help us identify this stuff. So flow is still very important. Despite the fact that we only went over the charts, it is nice to have this supplemental data. You just need to understand flow is not everything. Neither are fundamentals, neither are technicals. They all play a part in it. And so what I mean by that is the full market cycle, it's powered by fundamental news events such as security, like individual security news, earnings, macroeconomic news, hedging behaviors. It's also powered by technicals, which would be accumulations and distributions and the various climaxes that occur when those phases are ending. And then also flow data helps give you extra insight into that volume. So what it all really comes down to is human emotion. So, and that's what drives this stuff. That's what's driven this bear market is the fear of inflation. That's what drove the last Black Swan event, was the fear of COVID crashed the market. And then there was a lot of FOMO, fear of missing out, that helped drive all these tickers way higher than they should have been. And then now, inflation catches up to us. Too much money has been printed. Bad policy was in place, and now things are dropping. And once again, it just comes down to fear, and it's all human emotion. And the hedge funds and the big banks know this, and they repeat these patterns because they work so well. And you can never just be looking at one thing. You can never base your decisions off of just technicals on a chart or fundamental news or flow data. It has to be a combination of multiple things to help you identify which phase you're in and get an idea of what they're planning and why they're planning it. So anyway, let's wrap that video up here. I will certainly do additional videos on tying this all together, along with live trade recaps, where we'll talk about these concepts, how I use them to take certain trades. But I really appreciate you watching. As always, if you have any questions or anything, feel free to let me know in the comments. And thanks again for watching.